This is London with Bitcoin Spike and VIP Trader. We're going to dig into the New York Open, taking a look at Tesla, taking a look at Bitcoin, of course, our mainstay, and taking a look at NVDA. NVIDIA is off to a nice start. We're going to look at just up 0.64%, maintaining some momentum off of the open with a bit of a breakout target from the bulls here in a flat top. Would need to be broken. Be mindful of this preceding area to the left, but to the extent that the bulls can maintain price up and over our golden short line essentially on that specific 15-minute. Note that that top level of the standard deviation is engaging on the specific 15-minute as of right now, with the target hit up and over that specific 20 moving average, and just a nice completion to at least the bulls are getting that immediate trade to that top side band. Very nicely done. Remember, we have a delay in the stream. This is just to cover some basic tactics as would be presented from the equity markets on open, because we get that volatility. As you'll recall, last week we really had an incredible, a nice hit into our green buy line on NVIDIA. Could we have gone lower? Absolutely. Was it an expressed level of acquisition in terms of a green buy line weekly on NVIDIA? Yes. 8% total. Very nicely done. Great to see our fire and ice coming into play. Very nice to see that. Right now on the hourly, you'll see the line that's getting hit here that's reinforcing the level of resistance on NVIDIA would be that specific cap line. You know that we look at levels of interaction on the market, definitely trying to come together with levels of resistance and support calculated, oftentimes kernel level. As advanced calculations, I will say this, as TradingView will allow, we are delving into the more sophisticated parameters of TradingView. So to the extent that you are trading, again, you guys know, former hedge fund owner, private, non-SEC, not financial advice. Let's take a look at what is going on with Tesla. We had some great volatility yesterday in terms of some pickups. Let's take a look at what's going on right now in terms of a pattern formation. Yesterday was a beautiful drop. If you were paying attention to the pattern framework, it was an excellent play. Looking at that bottom line support right now, we would be cognizant of the Fibonacci's, which I've drawn out here, okay? Those Fibonacci's with the 23.6, the 38.2, trying to pick up immediately. And remember, we're always trying to look for the specific possible expanding volatility equation. That is front and foremost in terms of what we would like to see in the markets. It will be that volatility expression between the bulls and the bears. If you are lost in the charts, if you're looking yourself for an entry or an exit, we recommend that you look for and define the volatility expression between the bears on resistance and the bears on resistance, bulls on support, and that you identify value-driven entries long with expectations and potential opportunities in terms of shorts along a level of resistance, okay? Now, you've seen quite a few of those play out quite well over the preceding weeks. We'll go over a few of those this morning. I am back from being out of town. Yesterday was a quick trip out and back. I want to say just good morning. It's nice to be back as we watch the 38.2 attempt to pick up here on Tesla. Taking a look at the framework, I've got a few different charts to begin as we were to look at Tesla pushing down. As we were to consider really the break under, probably the most relevant feature here, as we're going to back out, look at all the time frames, is going to be the specific 20 moving average. Let me hide this real quickly so we can clear this up. That specific 20 moving average has just hung right below and what's engaging the bottom pro line. These are small trades right now, okay, as the buyers pick up on that hourly. As we look at that set underneath, probably the most relevant immediate cause of concern, along with some falling momentum here, which gave us a bit of an indication, right, that we could be seeing some downside price action, particularly our capital control line, specific RSI, stochastic MACD, boom. To the downside, we saw the specific hit on that 20 moving average. We saw reinforcement with a bit of a push on that capital control line, and we'll note the hourly is exhibiting some conformance therein. Now, I can clean up all of these specific there we go. Let's clean this up a little bit so that we can take a good look at what's going on Let's take a look at that 4 hourly. Definitely an eye grabber, right? As we would look at the specific potential here on that 20 moving average, it did reinforce, didn't it, quite nicely in terms of being a hurdle. You can say it, but to do it is not always easy. But bullish over, bearish under, particularly when you get some frustration in and along these levels here, which is why we look multi-time frame on that 20 moving average and the other technical indicators that we use. So looking at that 4 hour, it's a nice reinforcement of that 20 moving average, and we focus on the 20, but guys, we focus on a host of different averages, as you'll know that there's no one right answer as you were to look at that. Near engagement on our cap line. Tesla on the daily, if you'll see this, is very nice. That's within threshold. That's our capital control line. It's geared towards, and it's calculated at a very high level to express risk, okay, to the downside when we are red, RSI, stochastic, and MACD. We use it as a direct level of engagement as the calculatives merit such in terms of the level of sophistication or advanced calculations that are going into that capital control line. We have just found a nice level of consistency and back tested copiously with this specific capital control line. So we are very comfortable with it, and we use it cross time frame, cross asset, and it is really one of the strongest tools in your toolkit, without a doubt. So it's exciting to be able to talk about that in terms of guys increasing the wherewithal with your trade game, the results on your trade game. Take a look at Tesla riding underneath that 20 moving average on the weekly, right? We had some real fireworks last week, didn't we? Without a doubt. We do have a falling momentum on the weekly. The weekly can lag. You know this in terms of momentum. The weekly can definitely lag, particularly the monthly also can lag. You'll see the monthly momentum has been a pretty good indicator. So while the weekly, you see this rising momentum, you'll see the specific falling momentum. But you'll see rising momentum on the weekly, or on the monthly rather. This is the monthly chart. You'll see rising, falling, then rising right now on the specific monthly chart for Tesla. The contradiction herein would be the weekly. So we don't have confirmation as of right now in terms of a falling momentum on the weekly and a rising momentum on the specific monthly. Note such. When we have confirmation, it's easier to pick out. Unfortunately, it's easier to really notice it when we haven't had confirmation in a while. You know that. So while we're discussing the multitude of possibilities in terms of the technical indicators in play and whether or not we have a really strong foothold in one direction or the other, just understand that when we discuss complications, the benefit of a complication is when there is confirmation, it stands out. When we have agreement in all directions, you look at the charts and we just sit there and we say, no, this is special because we don't have anything else really to talk about except for that agreement all in one direction, all across all the time frames. So that's what we're really looking at capturing. Let's look at just real briefly in terms of Bitcoin. Bitcoin had a nice kind of power drive to the upside yesterday, and we looked at that specific 200 weekly moving average in the group. Congratulations to everyone who was long over and short under. You know, in terms of the application here, we can look at a few different indicators, but in the back, what was our specific go-to? Our specific go-to was on the 200 weekly, which also was confluent, which is important as we talk about that agreement or the specific confirmation, but the specific 200 weekly moving average was confluent with the 20 moving average on the weekly, this whole zone. So it was, I'll say this, it was my express communication that we are bullish over, we are bearish under, okay, in terms of that specific 200 weekly. That's the most prominent technical feature that is in play on Bitcoin. You can talk about the moon and the stars. You can talk about the Armageddon below, wherever price will be heading. I'll tell you, this 200 weekly is the critical line that has expressed itself. Just if you'll look at the last, is this year of pricing, 400 and some odd days. Let's take a look at this, the last 475 days. If you'll look at the specific line in play here, and particularly if you'll back test that throughout the entirety of Bitcoin, you'll just find that this is the line. You will also see that there are other specific assets such as Tesla. Look at Tesla on the 200 weekly. You can certainly see that the 200 weekly on Tesla is a line in the sand. That was an incredible buying opportunity in and around that 110, et cetera. So just reinforce your technicals. Sometimes they will behave specifically to your asset. Other times, you know that they will just work across assets such as that 200 weekly. And we like definitely to pay attention to Bitcoin and Tesla. We kind of started off looking at the NASDAQ as we were to look at some correlative advantages we might be able to establish between the specific NASDAQ, the lead technology index, and US index, and Bitcoin, which is technologically oriented, certainly digital currency. So as we were to look at the expansion of our channel, and the focus right now as we look at not just Bitcoin, which is our mainstay, but the other equities, we're excited just to have the opportunity to assess them for purposes of incorporation into our Bitcoin trades. And that's really the purpose with which we schedule or quote unquote hammer into equities. Looking at the NASDAQ, bam, this is the specific critical concerning point, guys, factor of the NASDAQ, the tech sector. And the NASDAQ's holding up better. If you're hearing a lot of negative news on equities, you need to position yourself well, because technology is doing better as of now and has been doing better as of this year than the residual of the market. The other participants in the market, the other equity concerns, et cetera, have been chasing or trying to chase and really been incapable of chasing technology. So it's been the star-studded feature, lead mover, alpha producer in the markets. So that's something that we are excited to focus on as we were to continue to take advantage of guys capturing that alpha. As we would look at Solana, I will bring up Solana because I bring it up frequently as that key go-to additional concern that we would look at, that asset that we would trade in addition to Bitcoin, due to the liquidity, due to, I'd say it's a very well-known coin, obviously, or asset, and it's something that we just find some predictability as we were to continually attempt to drive our attention into higher liquid, more technically capable and consistent assets. So we don't chase too many Dogecoin trades. We don't chase too many, but I will say for purposes of technical conformance, Ethereum trades, okay? In terms of Doge and Ethereum, those may be some technical components. The XRP, the SHIB, the Matic, it takes a real special pattern and a special day for us to just say, it's time, it's hammer time, let's dig into it, right? On those specific assets. We like the more prominently featured assets that may have an institutional level of interest in them clearly. So as we were to look at the 200 weekly, again, what is the call here? It's over or under that 200 weekly. And you can say, well, if we just grind along the 200, there are also trades in and around that 200. Most certainly, there are trades in and around that 200. Multiple engagements here, longs. Okay, a nice short opportunity, near perfect hit, depending upon USD or USDT, in terms of that short to the downside. And we just saw a lot of confluence yesterday, a lot of confirmation on the specific drop here. We saw a lot of confirmation on that. I think you all will say in the back that was not easy, quote unquote, but it was, as we would say, but it was, if anything in the market is easy. You may have lost your challenge and your edge, so we don't want that to happen. But what I'll say is we saw a lot of, and we can go over, let me see this Bitcoin chart. Let me go into the specific hourly. Let's go into the hourly. Let me make sure that our capital line is on. There we go. Now I don't have the 200. The 200, of course, is going to be in view mode only. However, I got in view mode only. That's not where we want to be. There we go. Okay, I was looking for my specific labels to the left, and I was in view mode only. We don't want to be in view mode. Let me get out of that. There we go. Let's see if I can pull up. There we go. My specific tools. In terms of the specific move to that downside, we just saw in the red background just means momentum was just dropping in terms of that move back down. And you can fight momentum for so long. You can fight the RSI, stochastic, and MACD for so long. And it's a difficult battle if and when you see an expressed momentum shift like we did yesterday. And of course, the idea is, well, we're just going to keep continuing going up. Targets had engaged. It was a nice move to the upside. And when you're I would just say when your specific personal target, i.e., well, I want this to go up, or I want this asset or that asset to go up, when it is, and you'll just see the nice target that did engage to the downside. In terms of that specific 20 moving average, you got it. On the 4 hourly was very nicely expressed. You'll see continued hits on the 4 hourly, very nicely expressed, right? As we would look at your target, just remind yourselves, and we always say, first of all, establish a target. Second of all, you need a pattern to get to your target. Very important, as we would remind you of that, as I would remind you of that. Just don't blindly trade in a direction. And I would say you need, it seems like it's asking a bit more, but in terms of the requiring a pattern to get to your target, if you're looking at NVIDIA on the specific 452 threshold breakout, we would say, well, you need and we would say you would need a target. First of all, you need a target, then you need a pattern to get to your target. And you can also say thereafter you need confirmation of your technical indicators to get pricing up and out of the pattern in the direction that you're oriented in terms of your target. This herein is an example. This is a wonderful example on NVIDIA. We've also had this recently on what is this? On Solana before the launch. Really did a nice job on this. Bitcoin, of course, has done a great job on this. Tesla, we'll review the expansion dynamics on Tesla. But to take a look here on NVIDIA, just to remind you why we focus on these pattern frameworks. And you can try and place this and discount it or not by it being something you really understand. It's a broadening, descending wedge. It is a volatility expression. It is a profit equation. And while we're retracing, which is the last thing generally that people would want to do if you're long, just right out of the box for new traders, I'll tell you this. It is an expression of bulls, okay, picking up, handing off to bears. Bulls, the bears handing back off to bulls. The bulls picking back up, handing off to bears. Hit 1, 2, 3, 4. Gives us 2 hits along a level of resistance and support on the NVIDIA 15-minute chart. What is important about this? It is a designated volatility expression with an additional hit here, near secondary hit at this level along support. But the specific probabilities are what we're looking for to participate in this specified pattern after looking at the preceding 40 years in depth and the materials accompanying that, the empirical data of all the markets relative to this specific pattern. You can call it what you want to. We'll call it a bell pattern formation. We like to rock the bells, bam, to the upside. So this is our preferred profit equation due to the fact that, first of all, it includes levels of support and resistance that are identified for the bulls and the bears. Right? And within that, it has an expression of volatility, meaning we're getting increased moves between the support and resistance. Every move is an increased move. If we were to measure the amplitude, that's what we're looking for. We're looking for the volatility in the markets. Absolutely. And we're looking for the probabilities which effectuate our ability, or which enable us to capture the volatility that we're seeking in the market within designated parameters with the maximum probabilities possible. It just is. So first of all, we want the volatility. Second of all, we want the patterning, or we want those equations in play which are going to maximize our own personal involvement in said volatility with whichever specific asset we are looking at. So if we don't have the volatility on an asset, we typically don't want to look at it, even for purposes of incorporating or doing analysis, okay? As we were to look at NVIDIA trying to push up and over, let's see, on the day, NVIDIA 0.65, kind of a mild open here. I think we agree with that. A bit of a mild open, NVIDIA up 0.6, Tesla up 0.8, Bitcoin up 0.2, and Solana doing 4.4. That's a nice move by Solana. So as we were to identify or explain what we are looking at in the market, it is opportunity to participate in volatility, i.e. we need price moving. You got it. Then what is it after we identify volatility, or we have an asset with volatility? We want to put it in a framework that is going to be as advantageous to us as possible. Okay? We want to not just say, well, we have volatility, great, but how do we capture that volatility? How do we process the volatility? And really a two-part or really nearly three-part specific approach. Within the pickups long, the specific drop-off shorts, and within the probability, and this is where we can go into some further discussions, but within a probability, an expectation of, let's say, the bulls returning to the bearish established framework or breaking that framework. Within the bearish, and this is something we haven't really discussed in depth, but I will get into this in the next coming weeks. Within the bearish, okay, expectations or probabilities of getting down to the bullish framework, okay, or below said framework. We can look at, from the component, first of all, establishing a pattern framework that enhances our participation or identifies the specific volatility. Okay, that's going to be really step two after saying, great, something's volatile, good. Now we want to establish a pattern framework and capture it in a way that we can begin to really assess what our participation is going to be. Then I'd say the third portion of that, after enabling our assessment thereof, really the perspective from the bulls or the perspective of the bears. Okay, the percentage probability that we would get back to this specific line. It's not something that we discuss frequently. Okay, there's often, and I would say most of the times, if not always, more to the equation than what you're being presented with in any book or any chart, or what your understanding is. It's because we've discussed the entirety of the time what is our specific expectation of getting back to a level of resistance on this specified pattern. The level of resistance, we've been very geared towards the specific long end, the bullish end of the scope. What are the percentages of getting down to a level of support, and what are the percentages for the bears of getting below the specific level of support? Those are important questions, okay? And so those will be some issues that I'll begin to address here over the next several weeks, and maybe present some solutions to you to see if you agree with those solutions as we would look not just at the asset being volatile, check. In terms of the volatility being capturable, we want to capture it ideally, okay, check. We're on the same page with having the volatility, with having and capturing that volatility in our expressed preferred manner here. And guys, we are not going to eliminate the other patterns at all. We're trading every pattern. If you were to look at some additional specified pattern framework, let's say on Tesla, for instance, we have flat bottom indicators, and we have really designed those in mind with just the multitude of additional patterns that are in play. And this is something that's going to be next on the development shelf, just so that you know, as we look at descending triangles, ascending triangles, as we look at any return to function in the form of a throwback or a pullback. And just to recap, this morning, Dow off a bit, 0.42, S&P down 0.52. And it looks like the NASDAQ is down 0.66. So a little bit of a struggle as we were to look at the indexes here today. But as we were to talk about the additional patterns in play, what's nice about the flat top and flat bottom here on Tesla, as we're looking for that breakout on NVDA. Tesla, if you're seeing these red lines right here, these red lines are going to be indicative that we have a bit of a flat top going on in this direction, which is nice because that gives the bulls an indication that, okay, great, we have a specific curvature, we have a handle formation, that flat top resistance here, and it's time frame dependent. We have some additional, if you'll see into this zone, we do have a bottoming structure here with a designated flat top resistance here as well. So that I don't want to provide too much information in terms of what we're looking at on the screen, but each of these lines is designating something on a specific time frame that's highly relevant. Okay, so you'll see the bottoming formation designation. You'll see the specific top line resistance, and it's not cryptic in terms of being unable to be deciphered, but it does require a bit of getting used to on the specific additional indicator that I'm looking at as I look at providing a probabilistic advantage to ourselves in the market. It's just required that we pay attention to said flat top resistance or a bottom level established support. The green is a bottom level established support, and you would say, well, what is that really doing for me here? A bottom level established support. What is that really doing? If I see a green line, an equivalent level of support, well, it's telling me that we've got some sort of indication here across that there's a flat bottom support, even close here. And I wouldn't draw that, it's not precise, But looking at a flat bottom support, we would be looking for what? We'd be looking for a recovery, boom, back to that preceding level of flat bottom support. Okay, it's very important. As we would look at a flat top resistance, boom, boom. What does that mean to me? First of all, it's a breakout threshold, sure. But as we look at a breakout threshold, flat top resistance, what is it? Well, we're looking for, yes, a breakout possibility, but what? A return, boom, to that preceding flat top resistance level. So that's where things become interesting. So it's not just an all-in focus on the specific volatility equations, okay? It's not just, as we were to talk through our strategies, obviously they're very complex, and obviously they're at the top of the food chain, we would say technically in terms of the market. Let's take a look at Tesla, looking at the specific 1 hourly. That specific lower pro line has engaged on fire and ice. Fire and ice, rock and roll, guys. It's good stuff. We love fire and ice. Exciting to have brought that and coded that up for you guys this year. It's been a huge success, and we're just very appreciative of anyone and everyone who's made that possible in terms of the trades, etc. I just really mean that. And from our own group, internal and external, there's a lot of people who work on the markets. Normally when I say that phrase, I'm referring to people who may be working on the markets and ensuring technical conformance beyond just exchange X, Y, or Z. All right. When I speak about, and I say that so that you understand who I'm really referring to, when I talk about like the integrity of the markets, I appreciate anyone who made this specific trade possible. Okay. There's a lot of work that goes on behind the scenes in terms of, let's say, accuracy, technical conformance in the markets overall. It's a highly technical field and full of some complicated features. So I'm really expressing just some gratitude to the markets at large and the individuals who do sit in seats and do have a control function over markets to keep them technically viable. Okay, so I don't want that to be a vague statement. I want you to understand that there are individuals who sit in seats and literally are trying to ensure technical viability of the markets. Okay, so that's a nice thing to know, that there are individuals in seats, and on what a great statement to lead into the Sam Bankman-Fried trial starting today. There are also some other people who we would not appreciate who might be in some seats in a remote, we hope they're in a remote seat away from any of us, of course, yeah. But looking at that, you just, with that level of control function that FTX had, just the misapplication of the authority, which is being put on trial. He's not guilty yet, but what we would say is we really appreciate a positive level of technical interaction and having those fundamentals re-expressed in a way that we can actually participate in them. So that's where that thanks and gratitude goes. And of course, thanks to all the VIP. You're awesome. Thanks to Venus. Hope you're doing well this morning. Thanks to who we got, J Mac, Liam, you guys in the back. I hope you're doing really well. And anyone else that I haven't chatted with in a little bit, Chris down under, Tony down under, an Australian crew. So taking a look at let's take a look at, we can backtrack into, what is this? NVIDIA on the, what time frame? The 4 hourly. Looks like we got an engagement here on the specific, nice golden short line. And so we won't get too bogged up into the specific flat bottom support, flat top resistances. It's something that I'm working on in the background. Of course, the fusion is going to need the machine learning will need a bit of a kind of training mechanism. I'm also focused on stochastic as kind of a different stochastic application that we're going to be looking at to enhance the ability to potentially stay in a trade. Okay, you get a lot of cyclicality on something like a momentum, which shifts quite frequently. One of the things that I like about a stochastic line, just so that you know, one of the things that is good, that I prefer about a stochastic line, is that if it is set up properly, it can exhibit some erratic behavior that is still directionally oriented. So if I were to look at my stochastics here on NVIDIA, pay attention please. If I were to look at stochastics here on NVIDIA, whereas on the other primary indicators such as momentum related or RSI related averages or kernel calculations, I would be maybe over inclined to really pay attention to the cyclicality. And as you trade with momentum, you'll see various situations where the cyclical will begin to roll over and it will begin to roll back to the upside, right? It will begin to drop and then surprise the traders to the upside. What I really appreciate about about stochastics is it's not as cyclically oriented, and depending upon how it is set up, it can have some aberration and some inconsistency that can be helpful in terms of keeping you in a trade. When you're looking at something cyclically turning over so smoothly, you're out, right? I'm going to tell you, when you trade a lot, it's like that's a problem. It's telling me it's going down. If instead we can attach a bit to or work into our analysis at least a bit of an aberrant or a bit more not randomized but inconsistently cyclically expressed general over or under notion, and therein combination, if we can pick up on the specific, move a bit earlier. So if there's any other additional advantage that I can get away from, and typically we want to be with that cyclical behavior. You know, we're always looking for the cyclical lines. What's the cycle telling us? From John J. Murphy on New York Institute of Finance, where Wall Street goes to school, looking at sunspots have their own cycles. Battles across the across history, hundreds and hundreds of years, thousands of years of history. Battle and warfare has its own cyclical expression, repeatable cyclical expression. So when we're looking at cycles, a lot of times we want to follow them. On the lower time frames we do see, and on the larger time frames we see divergences, right? So just stochastics is something that we're looking at in addition to this flat top and flat bottom support, just to enhance the trade game without a doubt. Let's take a look at Tesla. Still pushing along. It's a slow day for Tesla. You guys will agree after the specific set and test of the 20 moving average. Specific lower pro line on Tesla picking up on Fire and Ice. That's nice. If you don't have access to Fire and Ice, I am sorry that you do not, because that's an incredible, it's the best tool in the market that I know of. It is fantastic. Looking at the specific 20 moving average, bam, to the downside again on Tesla on that 4 hourly. Note such in terms of that 4 hourly and its prominence. Looking at the specific preceding level of resistance, essentially just kissing right into that specified trend line in and around on NVIDIA of that 451, 452. Let me get you a little bit more in terms of the specific details on that pricing. I hope you're all doing well. Looking forward to a good trade week. 451.68 there and about. So as we were to look at that requirement, we have a specific threshold breakout on NVIDIA to the upside in terms of this rounding formation here. We do have a left shoulder. We do have a head formation. For this neckline to really play out, you're going to find that it's going to be pretty steeply angled with this specific shoulder formation here. So when you assess your specific inverse head and shoulders, this is kind of I'd say this is very clearly an attempt to establish a bottoming bullish formation. We'd like to see a left shoulder with a return to said neckline, which is confluent with that top line resistance here, that breakout. The fact that we've underperformed here is really going to give us a high threshold up and above. If we were to define the specified inverse head and shoulders attempt below, and what I'll say is from that preceding comment, just be aware anytime that you are angled on an inverse head and shoulders breakout to the upside or to the downside, however that may play out on your pattern framework, be aware of such. It's nice to have flat specific necklines. They're preferred by the traders, okay? As we were to look at this specific feature here of the inverse head and shoulder, let's go ahead and draw some targets as we always do with the Fibonacci extensions. Trend-based fib extension, boom. What are we going to do? Trend-based fib extension, we want the targets to the upside here on NVIDIA. So we're going to click 1, 2, which is going to be click 1, click 2 is in the upward direction with that Fibonacci extension. If we click up, click 1, 2 is up, then just drag over to the point of the specific breakout, and that click 1, 2 up is going to give us targets up, okay? If we were to want targets to the downside, we're going to click 1, 2 down. So targets to the downside, click 1, 2 down, targets to the downside. If you want targets up, click 1, 2, targets to the upside, bam. Okay, so looking at the details, this would be I would say this is recognized within a bit of a complication. There may be an argument as to whether or not we have, well, is this really right here more of an equivalent left shoulder bottoming formation and a right shoulder? That is just, I'd say that's an indication that we're looking at a variable level, target level. As we were to look at the multiplicity of patterns that are being traded by the traders, we always like things simple. We like this. If we can get the same pattern on every time frame and some agreement between all the traders in the market in terms of the supply and demand zones, the breakout levels and thresholds, the targets on the tail end, and if we can get agreement, of course, between all the oscillators, all of the indicators on all the time frames, hey, we're marching in the right direction and with the right group, right? To the extent that we have a variable component here, again, it's not to confuse, it's just to express the fact that we're not in I don't want to say a transparent market, but we're not in, we don't have agreement between the market participants. There's one thing we could definitely say: we don't have agreement between the market participants in terms of just the targets that are in play. Okay, if we have one pattern, the specific, all the traders are essentially going to have one set of targets that are in play. If we have a multiplicity of patterns in play, by definition, we're not going to have agreement even between the traders in terms of what is or what are the consistent, let's just say, or the agreed upon, if we're going to use that word, and I'm going to hesitate a little bit, but we can just say we don't have agreement between the traders. If we have a multiplicity of targets as to any, let's say, overriding or any just authoritative, or what do we say, just any sole target in the market, we'll have with 5 different patterns on 5 different time frames. Depending upon what your time frame of choice is, we're going to have traders on all those time frames. We have more highly relevant time frames, but to the extent that we lack that agreement, and it's not intentional by the traders, of course, but you're going to have traders with their own preference. So to the extent that we have a multiplicity of patterns, we just have to note such. Right, we really have to pay attention to that and the complication it presents. If you don't want to say, well, the traders aren't in agreement right now, it would just be a fact due to the multiplicity of patterns that are in play. And it's not to say, well, it's not necessarily something that they're intending to do. Certainly not. It's not like they would wake up and just intend to, well, the traders are disagreeing this morning. No. So, but we just lack agreement in terms of the the levels in play. You sit them down side by side and ask them for their data, for their targets, for their entries, for their exits, and depending upon whether or not someone likes the 15-minute or the group of traders on the 15-minute, they're going to vary from the group of traders on the 5-minute. We may have a much better conformance here, even on the lines, and this would, this would be an example. If we were to look at this left shoulder, now was nearly, we would say potentially equivalent. There may be a time frame where the specific left shoulder here is nearly equivalent with this right shoulder here, to the point we might not need to drop, for instance, this specific line here to match up the specific left shoulder head formation or right shoulder. So to the extent that you have something with a greater degree of conformance reinforcing specific targets on one time frame with a few thousand traders versus the traders on the other time frame, if you were to just point blank ask them, like, what are your targets based on your time frame, they're going to give them to you, and they're not going to be in sync. So we look for that synchronicity when we can find it. One way towards achieving the synchronicity, of course, is candle functions. You're just going to find, in terms of the candle work, that they're going to give you more aggressive targets. So be aware of the fact that you're going to be in a bit of a compromise. That compromise that you would achieve is that you're going to, yes, achieve a more standardized approach to your targets, but you're going to have more aggressive targets. Okay, so if you're completely fine with that, you can get the same answer and the same targets, same breakout levels, etc. if you go to the candles, but you're going to get more volatility in the candles than you do on the lines. So you're also going to be looking at needing to adjust your specific target features in line with the probabilities, maximized probabilities, and with the understanding that you have made a bit of a compromise to achieve an overall level of conformity, right, amongst all the time frames, and get a higher level of confirmation, essentially, with the other traders, the higher level of agreement with the other traders who are all operating, all operating on the candle wick feature, which does standardize our target application instead of the multiplicity of differentiating lines on different time frames. And this is an important point to make. You just need to please incorporate, and you'll have to incorporate whatever additional volatility is in play on your specific candle features versus in comparison to your line features. You're going to need to accommodate for such on your on your targets. Now on the lines, for instance, we may get on the lines, we may get to the 23.6. On the actual candle wick feature, we may have an additional completely, and I'll cover that. I think that's worth covering. I'll cover it in a small video today for VIP, so you guys can really see what I'm talking about. But as you were to look at, let's just go over this very quickly. If you were to look at the expression here on a specific line chart, we may have something along these lines of a pattern, right? We may have this in terms of a pattern of a specific line chart. On the actual candle wick features, we may actually have a candle that goes down to here. And just pay attention real quickly. We may have another candle which operates up and through to here, another candle which operates up and through to this level, and another candle which operated up into this level instead of the line chart, right, that we're currently looking at. And if we were to do something along these lines, and let's say this was a pretty deep dig down into this level on this wick on the candles, right, the question is going to be the following. Well, if we are operating on the lines, and this will capture it well, this will prevent the need to do an additional video later, looking at the specifics here, and let's just cover this. Looking at the specifics, what are we going to say? Well, on the lines, we've got a target, real nice, easy, beautiful pattern and target to the upside. We're going to be carrying this amplitude to the upside. Ideally, we're going to be looking at a 50% completion to the upside. Now, this may be on the specific 5-minute or 15-minute in terms of this specific pattern, right? This may be the let's just say this may be the 15-minute pattern, or this could be, let's say this is the 5-minute pattern. What if the 15-minute line chart looks as such? What if the 15-minute actually went just like this? And it's we'll draw it in around the specific. What if the 15-minute did something about like this? Okay, on the lines. Now, if you were to look at this, you'll see more consolidated price action on the higher time frame. This would be the 5-minute. And in addition to the consolidation, not only are the specific, and you know this, but it's worth covering. As we were to talk about, well, the 15-minute still has a bit of an expression of this ascending triangle, but looking at this, wow, okay, so this is the 15-minute on the lines. You'll see a more consolidated, and it doesn't always have to vary in terms of the sets, let's say those the setting framework, but what we'll say is the following. If we were to look at the specific wicks should, and I will say will, if you find something that varies, I want you to let me know, but the specific candle framework is one thing that's going to match up. So as you look cross time frame, the equalizer here is going to be the candle framework that's going to match up between the time frames, between, say, hypothetically, the specific 5-minute and the 15-minute, right? So as we were to look at this, it's like, wait, okay, so we have, if this were the 5-minute and this were the 15-minute, we're going to have the same candle wicks in play. We just, as a matter of fact, on the 5-minute or the 15-minute, the specific price went to where the price went. It's going to establish the wick on the 5-minute or on the 15-minute. The question that we would look at and that we're assessing is, well, the traders who are trading the lines on the 15-minute versus the traders who are trading the lines on the 5-minute are looking at different targets. True? Fact. So as we were to look at the specifics here, let's take a look at, okay, so they're going to take the amplitude move here of the specific 5-minute, and this is where they're out of agreement. It's not intentional, it's just occurring. It is a fact. The traders on the 5-minute are out of agreement with the traders on the 15-minute in terms of the targets to the upside. When we have a great differentiation or a big level of differentiation between the expressed volatility on the lines, as we expect that consolidation on the higher time frame, what's occurring? Well, we're going to need to recognize the extent to which we have the variability to start with in the patterning, the extent to which that volatility is really going to impact our specific targets, wherein on the 15-minute on this pattern with an amplitude move, we're here at 440.65 as a full 100% completion on the 15-minute. We're here at 445, an additional $5 on price just due to the consolidated framework of the higher time frame. So this is a level where the traders would not be in agreement trading on the lines, which they may have found a consistency in. There may be an advantage to the 15-minute. You may have traded the preceding 500 patterns, and 75% of the time, the lines on the 15-minute are controlling, all right, based upon the empirical data. So this is an issue where you may still have quite a few traders on the 5-minute that are still trying to hit these top levels. In addition to that, let's say outside of the scope of such, to evaluate this and to put this into perspective, outside of the scope of such, to try and normalize, okay, or standardize the equation here, well, the trader may say, okay, great, well, the way around this is I'm just going to draw my specific pattern on the candle wicks, because that's going to be the same between the 5-minute and the 15-minute, right? If I were to remove the specific, this specific equation here, in terms of the lines, if I were to remove the lines and go to the specific candle wick features, I mean, this is going to work, because now we just solved the problem. Bam, there we go. Now I have what I want between the 5-minute and the 15-minute. And what's the problem with this? If you look at this, you have a much higher degree of, now it's in agreement between the 5 and the 15, it's still at odds with the lines on the 5, the lines on the 15, okay, and now the lines on the candles, which should be the same between the 5 and the 15. But as a matter of fact, as you're achieving the standardization, you're creating another dynamic independent of the lines on the 5-minute and the more consolidated lines and targets on the 15-minute. So as we attempt to achieve standardization, as we attempt to normalize this process, you just need to realize when, if and to the extent that you have found a specific kind of golden key, a high probability time frame that's expressing itself with a consistency of targeting. Okay, we find that on Bitcoin frequently. It's like the hourly line chart is really producing well. The hourly lines, for some reason, the hourly lines keep trading well on Bitcoin. Okay, not the wicks. Okay, so as you were to look at this, the first off the cuff, I'd say the first off the cuff suggestion is that you definitely need to pay attention to the increase in volatility that the wicks are going to present, aside from the line chart. So you're already in this more extreme, more expansive mode when trying to capture targets in terms of volatility. And what's being discussed here is the following. If you try and normalize, if you execute your targets based on a more, let's say, a more of a consideration, the entirety of the wicks on your specific patterns, just note that your targets are going to be higher, or your targets are going to be lower. Okay, you're going to have essentially some additional considerations there, as you would say, well, my maximum probability is to get to the 50%. I've seen the last 40 years of data, market data, and we're heading to this 445.82. Now, you need to be careful, because if we were to mark off the 445.82, if we were to compare this specific function here, well, that's our maximum probability, right? You're going to walk in and say, well, that's our maximum probability, the 50% completion to the upside based upon the candle wicks. What are you going to run into? Well, you have a host of, you see where the 50% hash is now. Well, that's above the specific full completion on the 15-minute based upon the consolidated price action on the 15-minute. So you're asking, you need to understand that you're looking at and this is a real, really, guys, a real facet of the market. As you're looking at your maximum completion on the candle wicks, you'll have a group that understands the dynamics, and not all traders will take this to a set extent. Most traders are going to look at, well, I just want the full amplitude move. I'm going to keep this easy. I want the full amplitude move, boom, raise it to the upside. Well, we look at maximum probabilities, fractional completions. There's higher probabilities of that 50% completion than there is to that 100% completion. Okay, this pays more frequently, looking at the last 40 years of back-tested data, period, across the markets, guys, and looking at hundreds of thousands of patterns, okay? So when we run into this dynamic and you try and normalize or get agreement, this is one of the more sophisticated features of your trade game, which will begin to develop, wherein you will not have a gut sense of what you should be doing. It's the worst thing to listen to in the market, guys. When someone would say, well, you just have a gut feeling. You know, you're gonna do this until you have a gut feeling in the market. They need to go home, guys. People who are telling people just to trade on their gut, nope, not at all. It's all data driven. It's all empirically driven with data, and it's not a sixth sense in the market. If you can't capture it technically, if you can't explain it technically, don't trade it. Okay? Because your gut feeling 9 times out of 10 is coming from what you watched last night. Most traders, what they watched last night, the opinion they just heard, okay, of someone who's trying to sell them something or otherwise, if you cannot technically express the patterns involved and the probabilities involved, do not trade it. That is my recommendation. If you want to just go on a hunch and on a whim, go for it. Let me know how it works out. But oftentimes traders are unable to distinguish between their quote unquote gut feeling and what they programmed themselves with, which is often an accommodating opinion as to where they wish price would go or where they're afraid of price going, right? And they're either going to fill themselves with some fear or fill themselves with some hope in the form of some outside non-technical, when I say technically inclined, and I'm saying technical features, I'm talking about some advanced diagnostics here, right? We're not talking about, well, we found a pattern, great. You found a pattern, great. You're prepared to operate in the pattern within the specific limitations of the preceding, let's say the entirety of the market history, right? You understand fractional completions, the differentiation between the lines, the consolidation factor as it would apply in a probabilistic manner of achieving, right, of achieving a higher return rate or level of consistency therewith, okay, on a specified target time frame, okay, first of all, and then you're able to differentiate within the scope of a wick versus a line, let's just say element of a lack of agreement between the traders. And you know where you're fitting in, you know why you're fitting in, and you know the maximum expression. The degree to which, and you'll start to think of the variable components of this. Logically, you'll start to think of the variable components of this. Okay, great. So one thing that's going to be determinative of this discussion would be, of course, how long the candle wicks are, as opposed vis-a-vis or in comparison to the specific line chart. We agree? We agree. That's a determinative factor as you would start to analyze this. So it's not overly complicated, as I'm giving you, though, an encouragement to refrain from producing for yourselves non-technically oriented, what would we call that? Just non-technically oriented, guys. It's almost it's almost like in the form of some degree of influence for yourself to accommodate a gut feeling in the market. Well, instead of that, right? Instead of that being your segue to your next big hunch in the market that's non-technically driven, start to identify the additional parameters in the discussion that I've laid out this morning that would be required or determinative in terms of situations where you would be able to minimize, right? To minimize the impact of the lack of agreement that I'm discussing, the complexities of what I'm discussing. That would be, for instance, well, let's say we have less specific, and let's do this twofold. Let's say we have less differentiation between, first of all, the candle wicks and the lines. Okay. So this is a different circumstance. This is something different. When I see this as a trader, I'm much more comfortable with this in terms of the level of agreement or not between the traders on the specific line chart versus the specific line chart versus the specific candle wicks. I like this situation more. It is more conformant. We have more a higher level of confluence or agreement amongst the traders who may be on candle wicks or maybe on lines. And let's say within that, on the 15-minute to the 5-minute here on the example, I also have a specific less of a deviation, okay, between the specified 5-minute and the 15-minute. So now we're talking. Now we're starting to eliminate the variables as they might present themselves and frustrate or cause a lack of agreement between the traders. It's like, man, the 15 minutes almost exactly like the 5-minute. Maybe the 5-minute, maybe I drew this almost a little bit too conformant, but when you start to see this across time frame, and you'll see it sometimes, you'll see the same pattern, like it just got down there somehow, right? And maybe the 5-minute, to flow this out well, maybe the 5-minute has a bit more, let's do this, and this will be a bit truer to form. Maybe the 5-minute has a little bit more of this going on, okay? The 5-minute is now just right in line with, look at this, right in line with that 15-minute. It's got some additional volatility expressed on the 5-minute, but really the level of supports are the same, level of resistances are the same. Now we're starting to get into some components, some variable components where we're not pointing to the lack, guys, of an answer ever. In terms of a complication, the answer's there. Just work logically to deduce into the factors as they present themselves to you, the complications as they present themselves to you, in form of the in the form of the what would you say, the reduction of the equation as would be required, technically speaking. We agree? I think we're all in agreement on that. Easily said. Way to start the Monday morning. Everybody's like, golly, we woke up, we have to think today. Not good. Not good. Let's back off just a little bit. But a very important discussion. Very important discussion. I'll have someone potentially rewatch this if and when, to the extent that they're looking to address cross time frame differentials. Cross time frame differentials and the framework in play, or the lack of agreement cross time frame and lack of agreement in terms of candle wicks versus line charts, etc. So we'll mark this one this morning. Looking at the additionals here, we will be covering a bit more machine learning over the next few weeks, just to go over some facets, and my goal is over the next month to start to cover, stochastic, to start to cover a little bit more in depth, as I'd like to add that to the machine learning suite. Stochastic, I'd like to learn that, to the machine learning suite. Looking again at, we will also be looking at on balance volume just a bit, just some volume considerations, which, while not horribly or wonderfully consistent, are part of that reduction formula as we try and eliminate some of the complexities between, for instance, just that, or the disagreement between traders, putting ourselves in a situation to further reduce the complexities involved is something we're going to be aiming at, okay, over the next several weeks. And it's not complicated. It's good stuff. It's good stuff when you start to operate as such. So this is London with Bitcoin Spike and VIP Trader. We will be coming with, guys, we'll be coming at you hopefully later this afternoon on the specific charts, looking at Tesla, picking up on the specific lower pro line, targets below, you got it. Taking a look at that breakout needed, the 254, we'll call it 254.82. Okay, what did we have here that we noted was a little bit of a difficulty on Tesla? Just a note. When we look at the specifics on Tesla, what was it? It was a rising wedge, right? And so that rising wedge is, it has been a bit determinative here, as we would see it push once, and by push I mean level of support, traces out again after a retouch at the apex, bam. Apex meaning that peak, the result of resistance, support, the resistance and support demand equation function there. That is the apex, meaning that peak right here, the apex, that's that point, okay? So we will get in the back, we will be trading, and I'm looking forward to the residual of 2023 and further hammering into this alpha equation. Again, that's the percentage by which you beat the market. If you're not in the market for alpha, guys, I don't know what you're in the market for. And that's certainly what we're in the market for. So looking at that pickup on the lower pro line on Tesla, NVDA, looking at an activation on that 4-hourly golden short has reinforced now. And again, I'll be in the back. We'll talk about some additional features. This is London with Bitcoin Spike and VIP Trader. Nice to be back in the mix here after missing the actual beginning of the week. So we were, and I don't feel like I missed it because we were, I was on with VIP. So that was a good thing as we were testing out some live broadcast possibilities for me to interact in real time with the traders. So yesterday was a test, so I don't really feel like I missed anything. In fact, it could have been a great step forward. We're excited about not having a delay on YouTube, right? This 8 to 10 second delay where the market isn't actively engaged for you listening right now on YouTube. We're working on solutions for that, and we have one, so we're excited about that. You all have a great day. Nice to see some price action, and NVIDIA grabbed that 4-hourly line there, and of course, nice to see Fire Nice, bam, on the weekly. We would have loved to have picked up a little lower, had about 1.5% additional in terms of orders below on these specific levels that we weren't able to get to because Fire Nice just killed it on that weekly green buy line. Congrats to anyone who traded. This is London with Bitcoin Spike and VIP Trader.